Today I want to talk about how Citadel is absolutely finished. They've just had their credit rating downgraded to the same rating as Credit Suisse, aka right now Citadel is just as stable or unstable as Credit Suisse. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, as the French ape tweeted, both Citadel and Credit Suisse's bonds are both rated one step above junk bond status. This article released yesterday says Standard & Poor's cuts Credit Suisse's group rating to one step above junk status. That suggests that Standard & Poor's has noted material execution risks in the Swiss bank's efforts to get back on solid ground after a series of scandals and losses. Other ratings agencies also questioned the restructuring plan unveiled last week that envisions raising new capital, cutting thousands of jobs, and shifting the group's focus even further from investment banking in favour of wealth management. Now, we all know that a few weeks ago, Credit Suisse's credit default swap skyrocketed to a new high. That was then followed by this new restructuring plan when they're trying to basically break down and sell off the bank, and they're firing thousands and thousands of employees. Credit Suisse is desperate to raise $4 billion to be bailed out by the remaining banks, or potentially by selling off more shares to investors, diluting those investors and crushing the company further. And as a result, S&P has given Credit Suisse a rating of BBB-. That's obviously one step above this junk bond status. Now, Fitch also uses the same rating, BBB-, and Moody's uses Baa3. Now, if you didn't already know, Moody's Investor Services also rates Citadel securities a Baa3. Now, that's practically the exact same rating as S&P's BBB-, one step above junk. Now, that basically means that both Moody's and S&P believe that Citadel is equally as stable and equally as solvent, or equally as unstable and equally as unsolvent as Credit Suisse is right now. We know that right now Credit Suisse is basically screwed. They're desperate to try and stay afloat, willing to do whatever they can to raise additional cash to meet those margin requirements. Now, that basically means that Citadel is in the exact same boat, desperate to stay afloat. We know that Citadel is also desperate for cash, as they just issued a new $600 million loan. They've also been selling off investments left, right and centre, and selling off portions of their business, like selling off their investment in Melvin Capital. Clearly, Citadel is struggling just as much as Credit Suisse is to stay afloat and to maintain and meet those margin collateral requirements. And as Mr. Kin said, if you're a Credit Suisse investor, I hope you're reading their Form 6K. Credit Suisse are literally telling you they're nervous about their naked short positions. Credit Suisse's 6K says conversely, to the extent that we have sold assets that we do not own or have net short positions in any of those markets, an upturn in those markets could expose us to potentially significant losses as we attempt to cover our net short positions by acquiring assets in a rising market. Basically saying if certain stocks end up running up or end up squeezing, Credit Suisse will struggle desperately to buy those shares at higher and higher prices to close out of their short positions. But very interestingly, it also says that market fluctuations, downturn and volatility can adversely affect the fair value of our positions and our results of operations. Adverse market or economic conditions or trends have caused, and in the future may cause, a significant decline in our net revenues and profitability. Basically saying that a market downturn or a recession would decrease their shorting revenues and decrease their shorting profitability. Now, that sounds like to me that Credit Suisse is basically saying that if the market crashes, some of the stocks they are shorting will end up squeezing and they will struggle to cover their short positions in a market downturn. As Mr. Kin said, it sounds like Credit Suisse is very nervous about their naked short positions. And obviously, if you haven't already, be sure to join the free Discord linked in the description below. We've got 1348 indicators and we talk about AMC all day long and share due diligence as well. And if you haven't yet signed up to Moomoo, be sure to sign up right now using the link in the description below. You can currently get $10 free and 15 free shares on top of that, worth up to $2,000 each, a grand total of up to $30,000. And as Avi tweeted, this also massively impacts Credit Suisse as well, bringing them closer to a margin call and closer to bringing down the entire system. He asks, what does this downgrade mean for Credit Suisse with its credit default swap position? How will their liquidity be impacted? And what effect does this have on the financial industry as a whole due to the network of banks involved with Credit Suisse? Well, if a company like Credit Suisse is downgraded by a rating company and Credit Suisse is taking the other side of its own credit default swaps, they may be required to stump up additional collateral for the increased liquidity risk. On top of that, Credit Suisse will also likely be required to stump up additional collateral on their own loans that they have with other banks, aka providing additional security for those loans, and also providing additional collateral and additional margin requirements for stocks that they're holding. And as Avi tweeted, this also has a massive ripple effect on the entire financial industry. Banks and financial institutions tend to take out credit default swaps on each other. So when one of these institutions defaults, it can have a massive ripple effect like we saw back in 2008, for example with AIG. Back in 2008, when AIG was close to going down, many of these major banks had billions if not trillions of dollars of exposure in total to AIG, and many of these major banks almost collapsed as a result of AIG almost collapsing. And he said credit default swaps is a $607 trillion market. Its impact on financial institutions is huge. A slight swing in the wrong direction could have a detrimental impact on companies selling credit default swaps and the entire market as a whole. And he said, in my opinion, a meltdown will indeed cause the short squeeze, and therefore the short squeeze is still on for AMC, GameStop and Ape. And as a prime example of just how far into this market crash we are, but just how far there is left to go, Pip and Sammy tweeted saying Apple is down around 25% from its 52-week high. However, Microsoft is down 41%, Amazon is down 52%, and Facebook or Meta is down a whopping 75%. He said that hedge funds are failing, and all of these hedge funds all buy the exact same stocks. Therefore, many of these hedge funds are about to collapse. We know that basically every single hedge fund and every single asset manager out there all own Microsoft, they all own Google, they all own Apple, Amazon, and Meta or Facebook. Most of these hedge funds have Meta, Amazon, Microsoft, and Apple as some of their largest positions, if not their largest positions, top 3, top 5, or at least top 10. That means that basically every single hedge fund out there is down massively on these investments that are down over 50%. And that means that many of these hedge funds are indeed about to collapse, and they are indeed edging closer and closer to a liquidation. When a hedge fund's two largest positions are Amazon and Facebook, there is no way the hedge fund as a whole isn't down 50 to 75% because those are the largest two portions of their portfolio. Especially when you factor in that many of their other large holdings are also tech stocks that are potentially down even more than 75%, down 80 or even 90%. And on top of that, it looks like these declines are also going to get significantly worse over the next few months in the new year. Unusual Wells has tweeted saying Apple has paused hiring through 2023 amid their recession fears. Apple believes at this point a recession is practically guaranteed, and therefore they've paused all hiring for the entire of next year. And Apple aren't the only company to do this, as Amazon Web Services is freezing hiring in multiple divisions. These companies are obviously down massively, they're becoming loss-making, they're losing cash through their free cash flow calculations, and therefore they need to cut costs somehow by freezing hiring. And on top of that, the Bank of England forecasts that inflation will hit a 40-year high of around 11% during the current quarter, and says that actually Britain and the UK has already entered a recession that could potentially last 2 years. So while the US isn't yet admitting that they are in a recession, the UK is indeed already admitting that right now we are in a recession and it could last a whole 2 years. And that would be a longer recession than during the 2008 to 2009 financial crisis. That suggests to me the stock market still needs to fall further, as the US isn't even yet admitting they are currently in a recession. And obviously if the market does continue to fall, it still brings those hedge funds ever closer to that margin call. And the European Central Bank's president is also saying that a recession won't be sufficient to settle inflation. And as Peter Han clarified, he says, "You're saying a full economic collapse is required to fix inflation and to fix the markets." So basically, not only are we going to see a market crash, we could end up seeing a full-scale economic collapse, which would practically guarantee the squeeze. In a full-scale economic collapse, we wouldn't just be seeing 10 or 20 hedge funds going under, we'd be seeing hundreds of hedge funds, if not thousands, and a number of major banks as well. If a number of major banks end up going under and hundreds if not thousands of hedge funds go extinct as well, we're likely to see the market continue crashing significantly further, maybe down another 30, 40, 50% or even more. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.